Okay, this video is a continuation. This is part two of what's going on the first week of the stock market in 2016. So hopefully you saw part one. In part one, the main theme of it was there's this race. There's a race of what hits the U.S. shores the fastest and the hardest. The economic slowdown that has affected Europe and China, is that hit us first, or does the money flow that's coming from this massive sell-off in China, which is individual investors, and all the money that is in Europe and UK that's going through quantitative easing, where people are being charged to have their money in the banks, is that money going to flow over into the United States, supply and demand, and run our stock market up first, right? So I don't have a crystal ball. I don't know which is going to happen. What I want to do in this video is talk about some of the support and resistance levels in the market so we can kind of track and follow at this next very interesting week. If China continues, we don't know if their circuit breakers are going to come into effect, how much the government's going to continue to fund their marketplace. But let's just talk about support levels and resistance levels. When you're looking at the stock market, whether it's an individual stock or an index like the S&P 500, there are support levels and resistance levels. So the best way to think about this is, let's say this support level is a sheet of glass and there's a ball bouncing. And if the ball falls fast enough and forcefully enough and hits this sheet of glass, it can just break through the glass and go down. Or the ball can bounce on the spot and bounce back up and go a different direction. Or it can, if it bounces on the same spot, this same fundamental spot long enough, eventually it can break through and crash down. Okay, so whenever, and the same thing can happen up here on the resistance levels, right? It can hit a ceiling and then it can bounce off and go a different direction. Now, we measure these things, and in tandem, we look at a mathematical measurement called a fractal dimension, which is measuring the energy of the market within these support and resistance levels. And what we're trying to determine is the difference between a trend and a pattern. Don't care about patterns, that's what goes on inside here. What we are looking for is a trend. So anytime the fractal dimension is above 50, you need to start paying attention. And if it's above 50 and it's at one of these levels, then you really have to start paying attention to look for a trend, a breakout trend to the downside, or a breakout trend to the upside. If it sustains above 60 for a length of time or even reaches 70, you really you're looking at a massive trend. So if you read my alerts, you know that back in October, November, I was very nervous because what was happening is these support and resistance levels created a consolidation triangle, a consolidated trading triangle, where the patterns were narrowing. They were bouncing and they were narrowing and they're bouncing and narrowing. And it forms this triangle to where you get to a point here where it's got to go somewhere. It's going to break out up or down. Now, if it's a high fractal dimension, and in this case, once in October and once in November, we were at this point right in here, a very narrow trading range with an incredibly high fractal dimension. And there was this trading vacuum. There was a vacuum on the downside of this, which meant that the breakout trend with this high of a fractal dimension would have been a massive sell-off. And you know when the last time we saw this? 2008. So we saw it twice, and we actually went to the defensive position for clients. We actually bought some put options in order to take advantage of this. And it ended up not happening, mainly because I just believe everybody's infatuated with the Fed, and I'll talk about that in a second. Okay, so now let's look at the current market in the context of last week. So the support levels on the S&P 500, so this is all S&P 500. The support levels on the S&P 500 were 2010 and 1920. The resistance levels were 1990 and 2105. Now, This measurement, I took this we looked at this at the end of December before the new year, and we saw this, and you know what, the market closed off on Monday after the Chinese sell-off, all the bad Monday. On Monday, the S&P closed at 2012, so it sat right on top of this support level. This Friday, after the bad week, what did the S&P close at? It closed at 1922, so it sat right on top of this support level. So this next week coming up, we need to see some kind of retracement up to a resistance level, and this is the main level. This is what we got to pay attention to. We need to see the market go fundamentally up to this and either stay here or get above it. If we hit this level and ricochet off in a significant sell-off in a day or two off of this, it is look out below. And if there is a high fractal dimension at this time, the fractal dimension is in the 60 or 70s, it's look out below. When I say look out below, meaning the next significant support level isn't down until 1520. So that's probably about a 25% sell-off. Now, if we can get up to 1990, hang around and actually move north of that and move toward this 2105 with a high fractal dimension, then we could see a really strong run-up, which is what I was looking for going into the first half of 2016. If you read my alerts at the end of last year, this is what I was looking for, is that because of this movement of money, I saw this happening. And if this happens, we get through 1990 with a high fractal dimension and the market moves pretty well, we could move up to 2520 without a problem. And so that's a really significant resistance level, okay? So let's talk about the Fed, because we are still Fed driven, and I just want to talk a little bit about, because the Fed, all this going on, the Fed is going to be doing something, right? And I've talked about this, and I have these other videos like the money supply video you should watch. But here we have the Fed. We're on this critical teeter-tot point, right? If they don't do anything, this one and done, that's what this means. I don't think that's going to happen. If they raise interest rates, like they said, indicated that we're going to raise 4 times in 2016. If they do that in this economic slowdown scenario up here, I think we're in real problems. Now, something you need to pay attention to is this right here. It's the ISM, so that stands for Institute of Supply Management, the ISM Manufacturing Index. You're not going to see this reported in the mainstream media. So what this is 300 of the largest manufacturing firms, and what they're measuring, what this index measures is, among these firms, the employment, inventories, new orders, supplier deliveries, and so forth. Now, this index, in fact, here, I can actually show you a picture of this. So what you're looking at here is a measurement, and just so you see the dotted line, that's where we're at now, and 50 is the critical measurement. Any reading above 50 shows manufacturing, the manufacturing economy is in the expansion mode. As you can see, anytime we're below 50, these gray bars here, these are recessionary times, right? So this is 2008 and this is 2000. So we've had 2 months below 50, right? So December was 48.2 and November was 48.6, I believe. Now, the Fed has never, I'll repeat it again, never raised interest rates when the ISM Manufacturing Index was below 50. Never. So we got to keep an eye on this, and I think that this dry powder scenario, you're going to start seeing a lot more of this talk about dry powder. The Fed has dry powder, meaning I think that this continues on, you'll actually see the Fed lower interest rates. Okay, especially if we continue with a struggle with stock market because of all stuff going on in China. Okay, so I hope this is helpful, just giving you a perspective and some things to watch for in the marketplace. Obviously, Safe Harbor Retirement, how we manage money, and the platform we use. We actually take advantage of a trend, whether it's a downtrend or an uptrend. In fact, I went and took a screenshot. This is all of our clients in their portfolios. This is just one client. So you can see that on the 5th, on Monday, that we bought the inverse NASDAQ 100. So a $61,000 purchase for one of our clients. I just chose one person here. Obviously, I have to keep this stuff confidential. I don't want to give too many details. But the point is that the way we manage money is we take advantage of the markets, whether they are going down, there's a downtrend, or it's an uptrend, right? So if you're not having your money managed by us, then you should be. So anyway, watch. If you picked up this and you didn't see part 1, go see what part 1. Watch the money supply video that will fill you in more on the Fed. All this is at thebrinkmanacademy.com. Also subscribe. Make sure you subscribe to this channel so you can get all these videos. And thanks for watching.